Today, we will discuss the myriad legal and tax implications of a so-called check the box election via Federal Internal Revenue Service Form 8832 in the context of a single member limited liability company. My name is Chad Cummings, and I am an attorney and a certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the law firm Cummings and Cummings Law. I also teach business law at Florida Gulf Coast University and hold 4 degrees, including 2 accounting degrees and 2 law degrees, together with a variety of tax, financial, and accounting credentials, which I apply for the benefit of my clients in my law practice. Our firm website is www.cummings.law. At the outset, let me say that I have encountered a number of well-intentioned but misinformed business owners and entrepreneurs who think that they know the law or can answer all their complex legal and tax questions by spending 3 minutes on Google or ChatGPT. That is a very expensive mistake. And the topic we are about to cover is a common pitfall for many small business owners. Therefore, I cannot emphasize strongly enough. Do not let your hubris and ego cajole you into making an expensive and potentially irreversible mistake by attempting to handle this complex matter on your own. With that caveat in mind, the check the box election is a pivotal option for a single member LLC that offers flexibility in how the entity is taxed. By default, a single member LLC is treated as a so-called disregarded entity for federal tax purposes. This means that the activities of the LLC are reported on the owner's personal income tax return, that's Form 1040 Schedule C. However, the owner can optionally elect for the LLC to be treated as a corporation for tax purposes, which can have significant tax implications. This election is made by filing IRS Form 8832, the Entity Classification Election Form. The decision to check the box requires a thorough understanding of the tax consequences and should only be made in consultation with an experienced tax attorney and CPA. This election will alter not only the way the LLC is taxed, but also the compliance requirements and reporting obligations of the owner. When a single member LLC elects to be taxed as a corporation, it becomes subject to complex corporate income tax rules under the Internal Revenue Code. As a result, the LLC must file Form 1120, the U.S. Corporation Income Tax Return, annually. This form requires detailed financial information well above and beyond the disclosure requirements of Schedule C on Form 1040, including income, deductions, and credits, which differ markedly from the schedules used for individual tax returns. Additionally, opting for corporate tax treatment may necessitate more rigorous bookkeeping and financial record-keeping practices. The LLC must maintain records that clearly reflect its income and expenses, and these will be scrutinized much more closely under corporate tax regulations. Understanding these requirements is crucial for ensuring ongoing compliance and avoiding potential penalties. One of the primary motivations for a single member LLC to opt for corporate tax treatment is the potential reduction in self-employment taxes. For some context, as a disregarded entity, the owner of a single member LLC must pay self-employment taxes on the net income of the limited liability company. These taxes cover Social Security and Medicare contributions and can be very substantial. By electing to be taxed as a corporation, the owner may be able to structure income as salary and dividends. Only the salary portion would be subject to payroll taxes, thereby potentially lowering overall tax liability. However, this strategy requires careful planning and strict adherence to IRS guidelines to ensure that compensation is reasonable and defensible. A significant downside of electing corporate tax treatment is the potential for double taxation. This should not be underestimated. Corporations pay taxes at the entity level on their profits, and shareholders pay taxes again on the dividends they receive. This contrasts with the pass-through taxation of a disregarded entity or a partnership where income is taxed only once at the individual constituent level. To mitigate double taxation, the owner might consider strategies such as retaining earnings within the corporation, distributing income in ways that minimize additional tax burdens, or filing a Subchapter S election on IRS Form 2553, which is beyond the scope of this presentation. Engaging with a tax advisor at the outset and before you take the do-it-yourself approach by sending documents to the IRS that have not been prepared or reviewed by a professional. Before you go that route, you should engage with a competent tax advisor to develop a holistic tax strategy that most closely aligns the financial goals of the business with that of its owner. While federal tax treatment is a primary concern, state tax implications should not be overlooked. States may have varying rules and regulations regarding the taxation of a single member LLC. And an election at the federal level does not always dictate state tax treatment. There are some complexities here. Some states may require separate elections or impose additional taxes or filing fees on limited liability companies electing corporate status. It is essential to review the specific tax laws of the jurisdiction in which the LLC operates. Consulting with a knowledgeable tax attorney and CPA can provide clarity on state-specific obligations and ensure that the LLC remains compliant with all pertinent tax laws. Once an LLC has elected to be taxed as a corporation, reversing this decision is not straightforward and therefore should not be made lightly. The IRS generally requires a significant period of time to elapse before a reversing election can be made. Typically, and there are some exceptions, an entity must wait 60 months, that's 5 years, before changing its classification again, unless there is a substantial change in circumstances. Given the nuances involved in both making and reversing a check-the-box election, it is imperative to consider the long-term implications carefully. Business owners should weigh the potential tax benefits against the administrative burden and lack of flexibility in reversing the decision, particularly with regard to the growth trajectory of the business and the propensity and effect on outside investment, for example, by venture capital or angel investors. Engaging with a tax attorney or CPA early in the game can provide critical insights and guidance tailored to the specific needs and goals of the business and its owner. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this presentation is general in nature and is not legal advice because legal advice, by definition, must be specific to a particular set of facts and circumstances. Should you have any questions regarding this important information or the content of any of my earlier presentations, please visit my firm website at www.cummings.law to schedule time for a consultation. I look forward to the opportunity to speak with and perhaps even work with you very soon.